尊敬的楼主席及与会同事们，早上好！很荣幸能有这个机会跟大家分享 GIC 的一些想法，请允许我以英语发言。While my comments are focused on the global environment and not specifically on China, GIC takes a deep interest in China, given its importance. We have a long history of investing in China, including having offices in Beijing and Shanghai. We see the investment world, like the larger world, in transition. In other words, we are in between moving from an old state to a new state. In transition, we tend to experience high volatility and uncertainty. The past 2 years were a good example. During the COVID pandemic, we saw, at its beginning, the largest and fastest contraction of global GDP. That was followed by an equally impressive recovery that was twice as fast as what we experienced following the global financial crisis. Financial markets mirrored that trajectory. The S&P 500 index suffered a 31% drop within 1 month from mid-February 2020. But it recovered all the losses within 6 months. In contrast, with 7 years with the dot-com crash and 6 years after the GFC crisis. The recovery was achieved by infusions of staggering amounts of monetary and fiscal stimulus. Interest rates were rapidly cut to zero. Governments spent about 10% of GDP in stimulus, and central banks pumped $10 trillion into the economy. Public debt in developed markets ballooned to more than 120% of GDP, surpassed only by the post-World War II peak in 1946. We are now paying the price. Global inflation has broken out of its 40-year downtrend. It will reach close to 8% this year, the fastest pace since 1981. The removal of stimulus and the rise in interest rates this year have also been equally rapid. Global interest rates have more than doubled from record lows last year. Some of them are back to levels before the GFC. Quantitative easing has become quantitative tightening, and containing inflation may see more interest rate rises. Most asset classes have seen negative returns. A balanced portfolio of 60% equities and 40% bonds has just experienced one of its largest drawdowns, falling 16% in the first 6 months of 2022. This is the lowest 1 percentile of 6-month returns since 1971. While COVID was the obvious cause of the extraordinary developments over the past 2 years, it is more accurate to say that it simply accentuated a few transitions already in the works. As the saying goes, things happen gradually, then suddenly. There are 3 main transitions warranting investor attention: a change in inflation regime, a new geopolitical landscape, and a new energy situation. Taken together, these transitions have the potential to fundamentally alter the investment landscape for years to come. We do not know where we will ultimately settle, but what we can say for certain is that the playbooks we have been using for the past few decades have to change. Allow me to elaborate on these 3 transitions. The first is on the new inflation regime. For 40 years, price stability has benefited from globalization, demography, technology, and policy discipline. This phenomenon is well understood. This has in turn benefited financial assets to a great extent. It is the biggest market story of the last 40 years. The lower cost of financial capital showing up as lower and lower discounting factor for future cash flows greatly expanded the present value of financial assets. It has also allowed relentless credit creation, adding to financial gains. Price stability is, however, under threat. Although inflationary factors such as COVID disruptions are expected to dissipate in the short term, and there is still a window to contain the current inflation spike, given the still moderate inflation expectations, there are reasons to believe that the inflation process has structurally changed. Inflation is likely to be higher going forward. Firstly, globalization is reversing. Fragmentations and frictions are appearing as countries and businesses prioritize resilience over efficiency for their supply chains. The result is persistent cost pressures for goods inflation. Secondly, demographic headwinds continue to mount. Aging reduces the productive capacity of economy, driving up prices. Thirdly, increased government debt loads may lead central banks to tolerate higher inflation over the next cycle. The second major transition is in geopolitics. For the last few decades, investors were generally immune from geopolitical risks. In fact, it has been the case of reaping the peace dividend brought by the end of the Cold War. For investors, occasional geopolitical flare-ups were often buying opportunities. This has changed. We are now contending with a drastically different geopolitical background. The peace dividend has ended. Instead of concentrating on cooperation in addressing the multiple global challenges, the major powers are focusing on competition and even confrontation. Investors can no longer afford to ignore this. COVID has revealed the extent of trust deficits in the world. Vaccine hoarding and the struggle to launch COVAX, that ambitious international COVID vaccine program, are two clear examples. The diversification of supply chains is a legitimate and rational response to these new challenges. Having alternative suppliers and building buffers makes sense for a world more prone to disruptions. But the risk is rising that this trend is swinging towards the extreme end of onshoring and friendshoring for production. These shifts are not just affecting trade flows, but also cross-border capital flows and investments. Never mind the efficacy, there is a clear cost to businesses and consumers. The third transition is energy transition, which comes with three goals: affordability, security, and sustainability. Each of these goals are highly challenging, and meeting all of them would involve significant trade-offs. It is also pressing. According to the International Energy Agency, the world will need to spend 4 to 5 trillion US dollar per annum for the next 3 decades to get to net zero by 2050. Given that we spent less than 800 billion US dollar on energy transition last year, activity and spend need to be rapidly ramped up by a factor of 5 to 6 times. There are tremendous costs to be incurred. The price of carbon will have to be higher over the long term. The implications for investors and portfolios are profound. At the broadest level, the boost to asset valuations from ever-decreasing interest rates are very likely to be behind us. Lower and lower interest rates have been a key feature of the investment market for the last 40 years, and without it, broad asset returns are expected to be lower across the board. Beta returns are going to be less attractive and reliable. In the more challenging environment of higher inflation, the winners are logically likely to be real assets. With cash flows tied to inflation rates, their top lines are protected. However, they too are not immune from higher real interest rates. If they use leverage, one would also need to pay close attention to refinancing risks. The increased significance of energy cycles, as well as the changing nature of globalization, will be particularly significant for the way that portfolios are invested in emerging markets. What countries import and export would matter more. For example, the types of commodities. More than ever, investors will be forced to scrutinize the impacts across the individual emerging markets and differentiate their allocations, rather than treat them as a block. The winners and losers will be stark. Let me share how GIC is responding to these challenges and uncertainties. At the most basic level, we have doubled down on our core investment principles. These include a continued commitment to portfolio diversification, taking the long view, and to prepare and not predict. In particular, knowing our strengths and limitations would be particularly important. While we are generally cautious, it is important to point out that as asset prices adjust to the difficult realities, therein lie the seeds of future recovery. Already, value is being restored in short duration credits, with both risk-free rates and credit spreads expanded. Or in the case of longer-term securities, the yield on 10-year US government inflation-linked bonds, or TIPS, has already risen by more than 200 basis points to almost 100 basis points, which means one can lock in the higher real yields to deliver with high certainty a return above inflation of 100 basis points per annum for the next decade. Now, the return is low, but so is the risks. In other asset classes, similar developments are playing out. In the important area of low carbon transition, we are proactively redeploying our capital. We view the investment universe as comprising three categories: new technologies, transition businesses, and stranded assets. We are very active in investing in the first category, new technologies, such as renewable energy, battery manufacturing, electricity grid software, green hydrogen, carbon removal, and even nuclear fusion. The opportunity set is currently relatively small, but we see great potential. The bulk of the investment universe is in the second category, transition businesses. We engage with and support our investees' transition efforts, including providing them with transition finance, such as to enable electricity utility companies to move from brown to green energy. For the last category, stranded assets, or assets with little prospects of transitioning, we avoid investing in them. We are also strengthening partnerships with like-minded actors across both the public and private sectors to catalyze meaningful climate action and collaboration. The three transitions I spoke of are not foregone conclusions. The window of opportunity to limit the most negative impacts from these is still open, but it will take public and private sectors working in tandem to do so. Fundamental to this will be trust. Trust is fundamental to investing and indeed to the functioning of markets. I mentioned earlier that these transitions are occurring against a backdrop of a breakdown in trust across various parties. The summit helps to foster dialogue and build trust. I'm glad to have the opportunity to share and learn from all of you. Thank you for your attention. 谢谢。